So here we are talking about cash flow based valuation. So in your notebooks, please write the title cash flow based valuation. Please write cash flow based valuation. Cash flow based valuation. So when we talk about cash flow based valuation, we are putting the whole discussion into two categories. You keep writing along with me. I'm not going to give you separately any time to note down this. Along with me you write. When we talk about cash flow based valuation, we have FCFF and FCFE. Now, what is FCFF and what is FCFE? Let us talk about that. FCFF is free cash flow to firm. On the other side, FCFE is free cash flow to equity. Free cash flow to firm and free cash flow to equity. First of all, what do we exactly mean by free cash flow to firm and free cash flow to equity, and why are we focusing on this term free cash flow? Why free cash flow? The term free cash flow indicates cash flow which is freely available to the firm, or you can say cash flow which is freely available to the equity or to the owners of the company or to the equity stockholders. You know one thing, that the true owner of an entity which is a company or a corporation are its equity shareholders, correct? All other contributories are treated like outside entities. Even the preferred stockholders, which are part of the shareholders' funds, but the funds contributed by preferred stockholders is not considered as owner's fund. It is still treated as an outside fund, because a company's relationship with a preferred stockholder is that of a fund provider in the form of capital. Stockholder, which are preferred stockholders, they do not provide funds to the company as borrowings. They provide funds to the company as capital, but they don't get interest on that. They only earn dividend income. So please try to understand the behavior of these three types of contributories. That is the debt provider, the preferred stockholder and the equity stockholder. How do you differentiate amongst these three? The investor who has provided loans to the company, that means the investor has subscribed to or purchased bonds or debentures of the company, or there is, say, a bank that has given loan to the company, there is a financial institution that has given loan to the company. We call all these contributories as debt provider. The funds that they are providing is classified as debt. Now, what is the nature of debt? You have to pay a committed rate of interest. So you are an entity, you have borrowed funds, you have borrowed funds from banks or financial institutions or by issue of debt instruments like bonds. You have raised borrowings for yourself and you have to pay interest on the same. Now the interest obligation will arise irrespective of whether you are earning profit or not. This is the nature of debt. When you have borrowed money, whether you earn profit or you don't earn profit, you have to pay interest. That is why debt creates financial leverage. Debt creates financial leverage. If the debt creates financial leverage, it is imposing the risk on the entity. Why it is imposing risk on the entity? What if there is shortage of profit and you have borrowed huge amount of money? You still have to pay interest. You cannot avoid the payment of interest. Are you people getting my point? That you cannot avoid payment of interest. Even though you have not earned profit, you have to still pay interest. Interest becomes your obligation irrespective of your profitability. On the other side, imagine what happens when the firm is able to generate high rate of return on capital employed. Debt over there, which creates financial leverage, gives you an advantage. What kind of advantage it provides you? It provides you advantage of trading on equity. Now, what is this trading on equity? You have learned at lower levels, right? What is trading on equity? Trading on equity is a phenomena where you are arranging funds by issuing debt instruments like bonds and debentures, or you are raising loans and utilizing that money in your business. Suppose your business has potential of generating rate of return on capital employed, say at 25%, and the funds that you have arranged is basically borrowed at just 10%. So suppose you have borrowed $60,000 at 10%. You are investing that $60,000 in your business at what rate of return? 25% rate of return. So 25% of $60,000, that is $15,000 you will be earning in 1 year time from that investment. But the amount of interest that you need to pay is just 10% of $60,000, that is $6,000. That differential comes to your pocket. When I say your pocket, means whose pocket? It is the equity shareholders, correct? The common stockholders will be getting that benefit. This benefit is definitely subject to tax. You will have to pay tax on that. So as I said, 15,000 is the return that you have generated out of utilization of that borrowed funds, but the interest that you have paid is only $6,000. $9,000 of surplus that remains with you. Obviously, the entity will have to pay tax on that because it is an extra profit for the entity. After paying tax on that surplus, the remainder surplus after tax definitely enhances the return for equity shareholders. Now, do you think preferred stockholders will have any role to play in this extra surplus? My question is, preferred stockholders, can they participate in this extra surplus? Answer is no, they cannot participate in that extra surplus because preferred stockholders have been promised, they have been promised a constant, a steady rate of dividend, not interest. So imagine you have shortage of profit. Will you still pay dividend to the preferred stockholders? Yes, to the extent you have profit available, you can pay dividend. But suppose an entity has not earned a single penny of profit, or say the entity has incurred loss. Are you still under obligation to pay dividend to preferred stockholders? The answer is no. You are not under obligation to pay dividend to preferred stockholders. Why? Because dividend, the term dividend indicates distribution of profit. Entity, if I am entity and you are stockholders, then entity has to first earn profit for the stockholders, then only that profit can be distributed in the form of dividend. That means something must come in the pocket of the entity, something must come in the pocket of the entity as free cash flow to equity. Only from that it will be distributing dividend to the equity stockholders. And to arrive at this amount, you have to first make the payment of preference dividend, that is dividend to the preferred stockholders. So please understand, these terms are highly relevant. Once again, putting back the focus on preferred stockholders, in the event of lack of profit or no profits or negative profits, the company may not distribute any dividend to preferred stockholders. But in case of profits, they will be getting the first chance of receiving dividend. They means the preferred stockholders. In the queue, the equity stockholders or the common stockholders will always stand at the last, because the meaning of the term equity as defined in international financial reporting standards also, equity is defined as an instrument that has residuary interest in the entity. Correct? When you are learning IFRS, you will have to have this additional piece of knowledge that equity instrument as defined under IFRS 9 indicates such instruments that provide the holder the residuary interest in the company. And what is meaning of residuary interest in the company? Means considering all the assets of the company minus all the liabilities, whatever be the residuary interest, the equity instrument holders will participate in that. So when it comes to a stage of liquidation, equity stockholders or common stockholders or ordinary stockholders will be standing in the queue at the end. Be it routine profit distribution, the common stockholders will be standing in the queue at the last, because these are participating in the residuary interest. Therefore, when you are talking about what will be the cash flow available to these people, you are talking about free cash flow to equity, FCFE. When you are talking about free cash flow to equity, do you know, when you are talking about free cash flow to equity, everything before arriving at the funds available for equity, means literally all your obligations you have to pay off, then you can arrive at free cash flow to equity. Now, why do we have two types of free cash flows? Why? Both of these cash flows play a big role for valuation. Now, when you are talking about valuation, which valuation you are referring to? If you are referring to business valuation, that means valuation of the business as a whole, then it is free cash flow to firm that you should focus on. If you are referring to the valuation of the equity, then it is free cash flow to equity. Now guys, here I want you not to go with the bookish learning. I want you to have enhanced practical real life knowledge, and that is where your understanding of these basic concepts, it is very, very important. So FCFF is used for valuation of a business. Now let me give you a scenario. Suppose I am a big investor, institutional investor. I have a huge funding and I am interested in buying businesses. I have two ways to establish control over any business. Two ways to establish control over any business. One is to buy that business itself. Another is to buy considerable stake in its equity. You know, buying out the entire business means taking over the entire business. When I talk about taking stake in the majority equity, it is also one way to establish control. For example, there is a company, say X Incorporation. If I want to have control over that company, I need not buy that entire business. I can just have majority equity holdings in that company by, say, purchasing 70% of its equity capital, by purchasing 80% of its equity capital. Anything beyond 50% will give me the majority stakeholding, correct? And that majority stakeholding gives me the control over that business, because I am controlling that entity, because I have more than 50% of its equity capital. I am controlling that entity. So guys, understand, what is my objective? What is my objective will depend on which cash flow I am considering. In other words, my objective will define which cash flow I have to use. So just imagine that I am interested in buying out the entire business. So whatever be the assets and liabilities of that other entity, all will become assets and liability of me, that is this entity. In that case, if that entity has already borrowed money from banks and financial institutions, those borrowings also I will take over. Then everything that belongs over there will now belong to me, whether it is asset or a liability. In that case, I am concerned with the free cash flow to the firm. But imagine guys the other way, that is when I am not interested in buying the entire business, I am merely interested in establishing control over that equity. In such case, what will I do? I have nothing to do with what are borrowings of that entity and all. I am mainly concerned in the value of the equity. Why? Because what I am going to buy, I will have to make valuation of that. In simple words, if you are attempting to buy a house property, you are concerned with the valuation of that house property. If you want to buy a car, you are concerned with the fair value of that car. Likewise, if you are interested in buying out the entire business, you want to know the fair value of the business. Whereas to establish control over that business, if you just want to buy its equity shares, you are concerned on the valuation of its equity. Here we need to understand that what is our objective of establishing control over the other entity. Are we trying to establish control by buying out the whole business, or are we trying to establish control by simply getting majority stakeholding in the equity? That is where our objective will define which cash flow based valuation we have to focus on, whether it is free cash flow to firm or free cash flow to equity. Now, once you have understood that we have this objective in hand, that we have to determine free cash flow to firm and free cash flow to equity, you just need to do one little task. You need to now learn how to determine both of these cash flows. What is the connectivity between both of these cash flows? And that is really required. So what I would suggest you is, make sure that you have written this whole stuff and then I take you ahead. Alright guys, so let us first talk about how to determine cash flows. Whatever I am writing over here, along with me, you also start writing in your notebooks. Please start writing along with me. So we always begin with gross revenue. You can refer this as sales. So gross revenue or sales, from that you subtract COGS, that is cost of goods sold. Subtracting this, what you have to then do is subtract cash operating expenses. Subtract cash operating expenses, and what you will get is EBITDA, EBITDA. Now, what is the significance of this calculation and how to make this? Let me explain this in detail. I think along with me, you are writing this whole content, right? Along with me, you are writing this content in your notebooks. First of all, COGS stands for cost of goods sold. So, you are generating revenue from making sales of your products and services. Then you are subtracting the cost of goods and services that you have sold. Difference between sales and cost of goods sold will give you overall gross profit, correct? The gross profit that you earn. But all your operating, administrative and selling expenses and other charges like interest, tax, etc. has still to be subtracted. So what we do is we first subtract only the cash operating expenses. So I want you to be very, very clear with this particular line, that is cash operating expenses. First of all, we are focusing only on operating expenses, means we are not including components like interest and tax. Then we are subtracting only the cash expenses, means non-cash expenses are not subtracted. That is why what you arrive at is EBITDA, EBITDA, that is earnings before interest, tax, depreciation and amortization. You know the full form of EBITDA, right? Earnings before interest, tax, depreciation and amortization. So what you need to do after this, the sequence of subtracting the expenses goes this way. After arriving at EBITDA, you subtract depreciation, of course amortization also. When you subtract this, what you get is EBIT, that is basically your operating profit. This is the first stage of what we call as your income statement. The first stage of your income statement where you have landed at operating profit. You have landed at operating profit. So we are focusing on one thing, the order in which you are subtracting all the components. So right from the gross revenue that we generate from sales, we just kept on subtracting each component by far to arrive at EBIT, that is your operating profit. EBITDA plays a significant role in your cash flow calculations. Lot of approaches of cash flow computation begins from EBITDA, certain begin from operating profit, that is EBIT. You need to have clear understanding of which is your starting point for computing the cash flows. The question in your exam may give you starting point as the net profit after tax. It can give you net operating profit after tax. It can give you EBITDA. It can give you operating profit. Anything as your starting point, and then they may ask you to compute FCFE as well as FCFF or any one of these. Guys, what is your starting point and how do you connect from there to the required calculation? That brain you have to develop, and that is why understanding the concepts and terminology is important. What happens, I have found students who just read, they understand. So in the sequence in which you have learnt your income statement, do you think exam questions will be styled exactly in that sequence? No, certainly not. Examiners can put forward tricky questions in front of you, and you will be able to correctly answer those questions only and only when your overall understanding about the concepts and terminologies is completely clear. So you have arrived at operating profit. let me take you ahead with the later part of income statement. Let me take you ahead with the later part of income statement. I'm sure you have written this whole thing already. So now at the later part of income statement, I would like to continue with EBIT. So EBIT, that is your operating profit. Because this is earnings before interest and tax, from this I will first subtract interest. Subtracting interest, I get profit before tax, correct? PBT, profit before tax. The profit before tax will be subject to tax, so less tax, say at 30%. This is basically assumed, the 30% rate is assumed. So after this, what you get is PAT, that is profit after tax. This is the second stage of your income statement where we have landed up at profit after tax. As far as my understanding goes, I required more explanation in the first part. I don't have to provide you much explanation in this later part. This is very straight and simple. I believe no one right now listening to me will be having any point of doubt. Just give me a quick confirmation by a clear yes or a no, that are we clear up to this stage. This requires no further explanation. The real explanation will start after this. Okay. So I am proceeding ahead with the next part for computing FCFE. So this point onward, pay a little additional attention on how we are progressing further. So now my starting point I'll keep as profit after tax less preferred stock dividend or preference dividend. When I subtract this, what I will get is earnings for equity. This is earnings for equity. That means earnings available to equity shareholders or common stockholders, correct? This will be, let me highlight this point, this will be earnings available for common stockholders. Okay, once you arrive at these earnings available for common stockholders, your objective is not to stop at this stage. Your objective is to go beyond this, because your ultimate objective is to compute FCFE, free cash flow to equity. Now from the beginning of your income statement, you have to look into the cash flow angle. Okay, cash flow angle. So you have written up to this stage, I'm sure, along with me, correct? So just let me scroll back and ask you few questions. Consider the fact that your sales proceeds you have collected in cash. That means this amount of revenue is basically a cash inflow. Your cost of goods sold you have spent in cash, so this is a cash outflow. Cash operating expenses, these are cash expenses, correct? So you would have obviously paid in cash. So this was cash inflow, then cash outflow, then cash outflow. So this is the net cash flow available. That means EBITDA itself is equivalent amount of balance that is available in cash. Then you subtract depreciation and amortization. This is the only point of major difference in your profit and in your cash flow calculation. Depreciation and amortization. I'm sure you know it very well. Just for you to recollect, depreciation is a steady charge on your profit that is arising by regular usage of tangible long-term assets. And the moment the nature of asset shifts from tangible to intangible, we then don't use the word depreciation, we use the term amortization. So amortization is applicable for intangible assets and depreciation is applicable for tangible assets. But both amortization and depreciation are non-cash expenses. So what is the true potential of depreciation? Depreciation as an expense or as a charge has potential of reducing your profit, but it does not have potential of reducing your cash flow because there is no cash outflow arising out of that. So as I told you earlier, this amount is a cash inflow, this amount is a cash outflow, this amount is a cash outflow, but this amount is not a cash flow component at all. So your operating profit is reduced by the amount of depreciation. In other words, EBITDA minus depreciation and amortization is landing you at EBIT or your operating profit. So your operating profit amount and the related cash flow amount, they are not same, they are different because depreciation has been charged over here. So we have identified that this is a little different type of component. This is NCE, non-cash expense. This is a non-cash expense, correct? So by far only one component of non-cash expense we have subtracted. So what happens? Suppose depreciation amount is $20,000. So you subtracted depreciation amount to arrive at EBIT, correct? You have subtracted depreciation amount to arrive at EBIT. Can we agree that the cash flow in your hand must have been 20,000 more than the amount of your operating profit? For example, if this EBITDA amount is $80,000, it is lying with you as cash. When you subtract depreciation, your profit reduces from $80,000 to $60,000, but your cash flow still remains $80,000. So in my example that I just gave you, EBITDA was $80,000, depreciation is $20,000 and operating profit is $60,000. So EBITDA is $80,000, which is representing the amount of cash with you that you have generated in the current period. Then depreciation has reduced your profit, but depreciation doesn't reduce your cash flow. So your operating profit has come down to $60,000, but your cash flow is still $80,000. That gap of $20,000 we have observed. That is only one component by far. Moving further. Now see, we arrived at this operating profit. Then we subtracted interest. When you say less interest, interest is not a non-cash expense. It is indeed a cash expense. You have to pay in cash. So this is a cash outflow. Likewise, when you paid a tax, it is also a cash outflow. So this is a cash outflow, this is a cash outflow. We are having no non-cash expense involvement in this part of income statement. Are we very clear on that? And when we arrive at this part, when we have paid dividend to the preferred stockholders, even there we have paid in cash, correct? Therefore, all the components considered for earnings for equity or earnings available for common stockholders, there is only one component that we have found as non-cash. And what is that? What is that? Depreciation and amortization, right? So what you subtracted earlier continues to have that gap of $20,000. If you want to arrive at your cash flow, you need to add back that $20,000. So continue to write further below this. On this we add back depreciation, which includes amortization as well. So if you want, you can write and amortization. You add this, and after adding this, what you get is FCFE, free cash flow to equity. I will write one point of caution over here. That is subject to other adjustments. Subject to other adjustments. Subject to other adjustments. So please write this much. I'm sure you are writing along with me. Now, if I take you ahead and focus again on one moment. Earnings for equity. And say earnings for equity is $40,000. To this you have added back depreciation. And that was $20,000. So now you have $60,000 in hand. You have $60,000 in hand, which we were about to declare as a free cash flow to equity. But the entity says, wait. This amount we cannot utilize for paying dividend to the shareholders because we have certain plans. What plans we have? We have plans to make additional investment in non-current assets or fixed assets like property, plant and equipment. We have plans to increase our working capital. So when you have to increase your working capital, this is the cash flow that you have generated in the current period, correct? $60,000 is the cash flow that you have generated in the current period. But out of that, say $10,000 you have decided to invest additionally in your working capital. $20,000 you have decided additionally to invest in your fixed assets. So increased investment in your fixed assets and additional amount of working capital that you have to set aside will bring down the free cash flow amount. Therefore, let us consider the additional facts over here. In this calculation, we would say less additional investment in fixed assets, say that is $20,000 and less additional working capital, that is say $10,000. Subtracting both of these, what you now get is FCFE, that is free cash flow to equity, which will be $30,000 only. So quickly take note of this and then I take you ahead. Alright friends, from here I would want to move ahead and discuss the next important aspect, that is net operating profit. Net operating profit after tax, that is termed as NOPAT, N-O-P-A-T, NOPAT, net operating profit after tax. Now, how do we compute net operating profit after tax? We start with EBIT, that is earnings before interest and tax. Let us assume that earnings before interest and tax, say it was $60,000 less interest. Suppose interest is $15,000. Okay, so your profit before tax will be $45,000 less tax at 40%. 40% of $45,000, it will be what? $18,000. And for the last remainder, that will be profit after tax, it will be $27,000. So your profit after tax is $27,000 in this example. But this is profit after tax. This is profit after tax, $27,000. We want not profit after tax. What we want is net operating profit after tax. So the question is, in this scenario, how do we determine net operating profit after tax? So friends, we have learned how to compute the amount of profit after tax, but the objective over here was to compute net operating profit after tax. And of course, this amount, net operating profit after tax and profit after tax, are two different components. So let us learn how to arrive at net operating profit after tax. So we start with the amount of profit after tax that we have computed. Profit after tax that we have computed was $27,000. To this we add back interest into 1 minus tax rate, interest into 1 minus T, and if I compute interest into 1 minus T, it will be $9,000. and therefore what we get is NOPAT, that is NOPAT, $36,000. Few things that I would want to clarify. What is the base of this calculation? How we got this $9,000? It was $15,000 into 1 minus tax rate, that was 0.4. When you take 15,000 into 1 minus 0.4, it is basically 15,000 into 0.6, and that is basically $9,000. So we are talking about computing net operating profit after tax from the amount of profit after tax. So few questions many students will be having in their mind, that sir, why are we adding this first of all, and then when we are adding it back, why are we considering this adding with 1 minus T effect? We are not clear with this. So first of all, you understand what has to be done. You start with the amount of profit after tax, you add back post-tax interest. So this is basically, let me write that also for your reference. This is called post-tax interest. This is called post-tax interest. It is basically called post-tax interest. So as I said, students have doubt over here. Two typical questions, that sir, why are we adding back this interest, and why are we considering this 1 minus tax effect? We are not clear with that. So let me bring forward that explanation over here. First of all, why are we adding interest? Because we want to arrive at net operating profit after tax. We want to arrive at net operating profit after tax. So if the net operating profit after tax is to be computed, you know one thing, interest on the debt, that is on all your borrowings, bonds, debentures, all types of loans that you have borrowed, the interest that you pay on that, interest is not an operating expenses. So in your business, when you classify the nature of expenses, interest comes in the category of financial expense. It is not an operating expense. As a result, if you want to arrive at net operating profit after tax, it has to be operating profit. So your operating profit, do you know in the previous working, what was your operating profit? What was your operating profit? Your operating profit was $60,000, correct? Your operating profit was $60,000. You want to arrive at net operating profit after tax. So I'll give you one good way of understanding this whole thing, which can clarify your logic tenfold. Look at this thing, what I'm writing on screen now. Writing work you can always do along with me. Please pay attention on this. I will write operating profit. I'll write operating profit as $60,000 less tax at 40%, that will be $24,000, and tell me what remains is NOPAT, NOPAT, that will be $36,000. Look at this, guys, look at this, what we have done. Operating profit, just for you to recollect from where we started this example, look at this, how much was your operating profit? Your operating profit was $60,000. What if we have not borrowed any amount? What if we have not borrowed any amount? Then there is no need for paying any interest. So we are focusing on one aspect, What if the entity is not funded by debt at all? What if the entity has no borrowings? In that case, there won't be any interest payment, correct? In that case, you will pay tax directly on your EBIT because interest amount is zero. So what if interest is zero? What if the interest amount is zero? Then you will pay tax on which profit? $60,000. How much will be that profit after tax if there is no interest? That is the meaning of net operating profit after tax. And to compute that, we have two different approaches. You pick the amount of profit after tax and you add back the interest, not the amount of interest that you subtracted, but giving the post-tax effect. Other way of computing is, on your operating profit or EBIT, you directly charge tax and arrive at NOPAT directly. But most important thing is, why are we making this computation? Why are we making this computation? The reason for making this computation is, we are saying, what if we have not borrowed any amount? We have no financial leverage. We have no financial leverage means our capital does not include debt. There is no presence of debt in the capital structure. If debt is not present in the capital structure, the capital is funded only by equity. In that case, how much will be your net operating profit after tax? In that case, whatever be your operating profit, that whole amount of profit will be subject to tax, and you will land up at net operating profit after tax by simply taking operating profit less tax. So I can give you one more equation. First, you do one thing. Make sure that you have written this part. Can I have confirmation that all of you have written this part? Yeah, all of you have written this part. So let me go ahead and give you one more equation over here. You can simply take NOPAT, NOPAT equals to EBIT into 1 minus tax rate. That's all. Straight away, this equation can be shortest way of computing NOPAT. Shortest way of computing NOPAT. It is EBIT into 1 minus tax rate. Means it is post-tax amount of operating profit. Post-tax amount of operating profit. That is the meaning of NOPAT. Post-tax amount of operating profit. Now, another fundamental question that arises over here. This NOPAT, do you think it will give you the base of calculation for FCFE or FCFF? Think logically and tell me. NOPAT will give you base for computing FCFE or FCFF? I am waiting for your responses. Come on. NOPAT will give you base for computing FCFE or FCFF. It won't give you the base for computing FCFE. It will rather give you the base for computing FCFF. Guys, when I take a calculative example, a big comprehensive example, it will consider all the components, and along with that you will be able to understand this to the next level. Okay, but that we are going to do in the next class. In this class, my objective is to just give you some clarity of basic terms and concepts. So, fundamental point of learning that NOPAT will give you the base for computing FCFF. So, let us write that line, an important line, that this factor NOPAT, NOPAT, will provide the basis for determining basis for determining what? FCFF. So now the obvious question is, how do you determine FCFF from the amount of NOPAT? So the point is very simple. I'll just explain it to you. You start with the net operating profit after tax, NOPAT. You start with this amount, NOPAT, and to this amount you add back depreciation, and you subtract additional capex. You know what is capex? Capital expenditure means additional investment in fixed assets. You subtract that because that much amount of your cash flow will get reduced, and also subtract additional investment in working capital, and what you get is FCFF. This is how you arrive at FCFF from the amount of net operating profit after tax. Alright guys, now one important comparison that I want to show, an important comparison that we have made earlier. I'm taking you back. Look at this. In this earlier working, what did we learn? We took the base as earnings for equity, and we added depreciation, and we subtracted additional investment in fixed assets and working capital to arrive at FCFE. And 1, 2, 3, same three adjustments when we made over here on net operating profit after tax, we got FCFF and not FCFE. So if I give you a one-to-one comparison between the two, how do you start with that? Please carefully understand this entire working. So consider this tabular presentation where one side I'll be taking NOPAT. Okay, one side I'm taking NOPAT, another side I'm taking earnings for equity, and then I make some adjustments. Adjustments will be add depreciation. I'm adding depreciation over here as well as here. Then I'm subtracting less additional capex, that is additional capital expenditure, that I'm subtracting from both. And I am also subtracting additional working capital from both of these components. And when I do this subtraction, what I get as outcome in this column where I started from NOPAT, I will be getting FCFF as the final outcome, and where we started with earnings for equity, we will be getting FCFE as the final outcome. So please write up this as well, and then I take you ahead.